Hi, I'm Sean, host of NerdWallet's Smart Money Podcast. Today, we're taking on 3 of your housing questions in a lightning round. We'll be answering questions about how to shop for title agents, whether it's a good idea to pull funds from an IRA for a remodel, and how to tap your home's equity. I'm joined in this conversation by my co-host, Sara Rathner, and mortgage expert, Kate Wood. Kate, welcome to Smart Money. We talk a lot at NerdWallet about the importance of shopping around when making a financial decision, but the home buying process is so lengthy and can be so exhausting that many might not want to shop around for yet another person to do this relatively small part of the process. Do you think it's worth shopping around for a different title agency? What do people really stand to gain?
So basically, saving some small amount of money, having some small amount of peace of mind, but very few people are shopping for the title agency for all of the reasons that you mentioned. So, when you are looking at your loan estimate, you will see all the estimated title costs listed under the section that says services you can shop for. So it is like, yes, you can, go out and see who you want to work with, but again, hardly anyone is shopping for these because once you've had an offer accepted, your mortgage application's been submitted, all of your, incentive, all that energy is really going toward closing the deal, just like get to closing. And so taking the time to suddenly step back and research a title company or research something like a home inspector, right? These different providers that kind of show up during the closing process, you just don't have the time, right? And you often don't have the energy. So if this is something that you really want to do, you are actually much better off doing it well before you've reached this stage so that you're not holding things up so that you can research. In the case of a title company, you're researching a company that's going to do research. So while you're kind of still in that like daydreaming phase where you're just like spending a lot of time scrolling through houses online, spend some of that time going through these different companies, look into different title companies, look into home inspectors, look into these different service providers so that when it does show up, you kind of know, what you're looking for or what you're not looking for. You can have some kind of preference, right, when the different things are being suggested. The one other thing that I would mention that the listener brought up was their example of the real estate agency and the title company having some kinds of financial ties, anything like that where there is that kind of conflict of interest. If that's coming up during any part of the home buying process, that could possibly raise some red flags for you. It is okay to step back and be like, oh, hold on, like maybe, let's not go there. Let's hit pause.
Well, now let's turn to the main part of Amy's question, how to tap the equity in their home. What options does Amy have?
Pretty much the standard options for accessing equity. So one is to do a cash out refinance. So that's where you refinance your original mortgage for a larger sum, and then you get the difference between what you owe on the original mortgage and that larger mortgage in cash. The other option would be to take out a second mortgage. And so second mortgage wise, we'd be talking about a home equity line of credit, commonly called a HELOC, or a home equity loan. The biggest difference between doing a cash out refi and doing a second mortgage, whether it's a home equity loan or a HELOC, is that with a cash out refi, you only have one loan. But interest rates have gone up a lot since 2020, and Amy's going to lose that 3.75% mortgage rate since prevailing rates are higher now. Cash out refi rates also tend to be higher than purchase mortgage rates since cash out carries more risk for the lender. So it's going to be a higher interest rate on a larger loan amount. With a cash out refi, you are going to have refinance closing costs as well. That's usually 2% to 6% of the amount that you're borrowing. So that's that total larger amount again. Closing costs with a second mortgage, with a home equity loan or a HELOC are usually lower. They're about the same percentage-wise, but because you're borrowing a smaller amount of money, since, the cost of your original mortgage isn't included, so 2% to 6% of, say $50,000 is usually a lower sum.
So how else does a cash out refinance compare with a second mortgage?
Well, with a second mortgage, as the name implies, you now have a second loan. So in this case, Amy would be keeping that original mortgage that has the low interest rate, but would now also have another loan on that property. And that loan would probably have a higher interest rate, both because prevailing rates are higher and because lenders consider second mortgages inherently riskier. So again, they tend to have higher rates too. like I said before, that interest is on a smaller sum of money. So there's some math to consider here. In terms of if we're looking within second mortgages, the differences between a home equity loan and a HELOC. A home equity loan is like a one-time lump sum payment that usually has a fixed interest rate. It's pretty much a straightforward loan. The biggest difference is that it's secured by your house. A HELOC is a revolving line of credit. And so that's usually more meant to be used over time. You have a credit limit, you borrow money as you need it, you repay it over time. And HELOCs usually have variable interest rates. So that can kind of fluctuate as the market goes up and down. Because of the sort of like, pay as you go or take money as you need it, people most often use HELOCs for like big renovations or like a lengthy home repair where it's like, something else comes up and now we have to pay for that too, that kind of thing. Whereas home equity loan, you're saying upfront, okay, this is how much I know I want to borrow and I'm borrowing all of it right now.
So what sort of return on investment can people really expect from different kinds of home improvements?
Okay, so please do not get me started on home improvement shows and especially all the kind of cosmetic things that you just mentioned. We're going to set that aside for another day. But for now, home improvement is, if I can tell you one thing, let me emphasize, home improvement is not something where you can think, okay, for every dollar I'm putting in, I'm going to get $1 out, let alone get more than $1 out. That is simply not how this works. If you're really looking at like, okay, what's the ROI? What's the return on investment I'm going to get on this project? That varies dramatically. But it's something also that you can research, you can look up. Remodeling.com does an annual cost versus value report that you can find online. It's super interesting. You can look at national numbers, you can break it down by region and see average cost and the return on all these different projects. And usually what they find is that the projects that have the best ROI are almost always like the least sexy and not really things that you would think of as like adding a lot of value. So replacement garage door, almost always at or near the top of their list. And even that is like, yeah, right?
It's so
and
boring.
Even that's like, it's so boring, right? New garage door. But that, even though it usually is like very close, it's not the top item this year, but it's near the top. You make the money back, right? The projects that tend to have the worst ROI on their list are a lot of ones that you might think would be a lot higher. So things like an upscale kitchen remodel. Like on one hand, yeah, like these are things that are going to lose value because of wear and tear. So appliances aren't appreciating over time, even if they're like Miele or Sub-Zero. But also, these are rooms like your kitchen, your bathroom. These are spaces that are really personal. And so one person's lovely, tasteful kitchen is another person's like hard pass. I don't want to buy this house.
And that said, these remodels are also extremely expensive. Like we remodeled our bathroom here. It costs like $20,000. Don't think we're going to see that back dollar for dollar when we eventually sell this house, if we ever do.
I don't want to promise you, but like I can almost promise you, yeah, you won't. And I know I did say like at length that I don't want to talk about them, but really the aesthetic stuff that tends to be the focus on TV is like your lowest ROI. People are going to rip that shiplap straight off of your walls. If you really want to make like a cost-effective improvement, upgrade your HVAC. Right.
Oh, yeah.
So energy efficient upgrades that will increase your comfort and will eventually save money are a win-win. If you're thinking about resale value, it's something that shoppers tend to be looking for. The other thing that you want to consider, which this listener does mention, is what is going to fit in with your living room. So if you are like putting in marble counters and you're on like a linoleum street, when it's time to sell, right? People always say, oh, don't buy the most expensive house on the block. You don't want that to be your home. You want to be relatively comparable, relatively in line with your area.
Thanks for watching. I'm Sean Pyles, host of NerdWallet's Smart Money Podcast. If you learned something new today, hit like and subscribe and share with your friends. Also, listen to NerdWallet's Smart Money Podcast wherever you get your podcasts.